online, fluffing around, trying to get the technology working. Always a challenge for me, I have to say. Thank you everyone though for joining us today. We have about 50 people registered and we've currently got about 12 line. As usual, people are still dialing in every minute. So I'm going to do a couple of preamble comments. We're going to do some technical instructions and then in about 5 minutes we'll start the main body of the webinar. During the course of the webinar, you're free to ask questions and Katie will indicate how to type in your questions so we can deal with them. I've also got two special surprise guests today. I have Luca Bottolo from the European Covered Bond Council and European Mortgage Federation, who will join me briefly to talk about what in the world the Commission means about green supporting factor, which has got a lot of media attention recently in relation to green mortgages. And then I'll have Ingrid Holmes from E3G joining us to talk about the proposals around infrastructure, green infrastructure investing, sustainable infrastructure investing in Europe that we've made in the report from the high-level expert group on sustainable finance and what that means for Europe. But to begin with, I'm going to go into instructions. So this is a short webinar for climate bond partners on the report that was released 2 days ago from the EU high-level expert group on sustainable finance. The European Commission, as you can appreciate, seems to like long titles. HLEG has been the acronym that's been used in the media. I'm just in Brussels now, fresh from a meeting with a number of European Commission commissioners to hear their first responses to the report. It's been a very positive day we've had talking through the issues in them, and we've been told that on the 22nd of March, the European Commission will present its action plan for a sustainable European economy and sustainable European financial system as a response to the HLEG report and as a response to many submissions that have been made to the Commission in the last year around these issues, including the submissions by the European Covered Bond Council, of course, who's been having a direct discussion with them. Today we're going to run through the key recommendations. Katie, can I ask you first to run us through the technical aspects of this particular webinar?
Yeah, sure, Sean. Can you just move across one slide, please? Thank you. So this here, the slide shows how to connect your audio. So hopefully, for people who don't have their audio connected, they can at least see it for a couple of minutes. We're going to have this. We'll start off with a presentation, and then we'll have a dedicated Q&A session at the end of the presentation. Sean, can you move one more? Sorry, Sean, can you just go to the next slide?
My apologies, Katie. I'm not a very good technical assistant. Thanks for prompting me.
Okay. So you can submit questions at any point during the webinar by using the Q&A box at the top. Everyone's muted, staying on back and things, so the way to submit questions is through this Q&A on the top right-hand corner. You can see it circled there in the presentation. Once we come to the end of the presentation, I will then pass questions to Sean and the other speakers who will be on the line at that point. This webinar, sorry, if you're dialing in, you can send questions to email by emailing to me, Katie, that's Katie, @climatebond.net. This webinar is being recorded and will be made available to the participants and those who've registered shortly. That's all on the housekeeping, so over to you, Sean.
Thank you very much, Katie. Also, if the audio, you have any problems with your audio, please also type in comments or email Katie, as she said. Okay, our agenda for today. A quick look at the key recommendations. Another look at what we see as the trends for 2018 coming out of the recommendations and other issues around bonds, what to expect out of this, and then Q&A. Feel free to ask questions as we go. We'll see whether I can get to them, whether I'm clever enough to see them on the side panel of our webinar screen. We'll address as much as we can. So this is an expert committee that was formed a bit over a year ago by the European Commission, DG FISMA to be precise, to have a look at sustainable finance issues in Europe, what the challenges are, what the opportunities are for Europe, and to make recommendations for action by the European Commission. In July, an interim report, a discussion document was released, and in December, we started preparing our final recommendations, which are published 2 days ago, and they're available on the European Commission website, or if you go to the Climate Bonds website, you can see the blog that was published a couple of days ago, and there's a link to all the reports. This has got a fair amount of coverage in Europe, which has been very exciting to see the extent of interest in this sort of topic and the broadly supportive issues. There are 20 key experts involved in the committee. I won't go through the list now. They're all available on the website and the report, but from countries right around Europe. And the imperatives have been to improve the contribution of finance to sustainable and inclusive growth, as well as the mitigation of climate change, and to strengthen financial stability by looking at how we can incorporate ESG factors into investment decision-making in Europe and the Commission's role in delivering that. Now we're waiting for the action plan. The key recommendations. The first one, and perhaps the one that's got the most coverage, I have to say, to my pleasure and but still surprise, has been the idea to establish and maintain a sustainable taxonomy, or a taxonomy of sustainable assets and projects at the European Union level to provide guidance for investors, for issuers, for regulators, and for retail investors and ordinary citizens about what are the priority assets and projects that need investment in the context of the challenges we face. We've done quite a lot of work on that. We've looked at social issues, environmental issues, climate change as the most urgent of those things to address, and there's some recommendations. I'm going to talk a little bit more about that later. The second one has been the need to clarify investor duties around long-term horizons and sustainability preferences. You will have been aware of much debate in the community about short-termism, long-termism in the financial sector, particularly after 2008. Very unclear in terms of what has to be done. It's also been seen to be unclear about what the appropriate investor response here is. And the Commission was very interested in the discussion around this. The report looks at recommendations around that, and I'm going to say that the Commission has given a very strong signal. We've had now 3 speeches by Vice President Dombrovskis that a sustainable taxonomy will be adopted by the Commission, that the recommendations will be taken on board and dealt with and suitably addressed, and also that they will be looking at the clarification of investor duties. That is going to be an important part of the work of DG FSMA in the next few months. The third area has been the need to upgrade disclosure rules to make sustainability risks fully transparent, starting with climate change. And this draws specifically on the work on the Task Force on Climate Finance Disclosure, chaired by Michael Bloomberg, convened by Mark Carney, the Bank of England Governor, in his capacity as chair of the Financial Stability Board. That has been an incredibly influential and useful report, and many countries are now looking at the implementation of those particular recommendations. The fourth one has been to empower citizens to connect to sustainable finance through a retail strategy, entailing investment advice and eco-labels of minimum standards. We believe, at the high-level expert group, that there is significant and substantial demand on the part of European citizens with investments for the opportunity to put their money to work, to earn a reasonable income, but also to contribute to important social and especially environmental goals in the context of climate change. However, in that context, like any retail kind of sector that's going to grow fast, it is important that there is appropriate guidance, review and management to benefit the sector by giving a spur to where it should grow, and also to protect citizens and investors so that we can avoid consumer scams and so on. So there needs to be an investigation of exactly how to go forward in this. A classic thing to do is to develop things like eco-labels. There are many precedents in Europe for this. Europe has been one of the global leaders in developing what I call labels of trust. We need it in this area as well. Moving on recommendation 5, to develop and implement official European sustainability standards and labels, starting with a green bond standard. And again, Vice President Dombrovskis said when we met today in Berlaymont, the headquarters of the European Commission, they will absolutely be moving ahead with a green bond standard. Of course, one of the other things Dombrovskis has been saying is that one of the things they will look to underneath this standard is now for what has been called in the media and green supporting factors. Specifically, Vice President Dombrovskis has said that he expects, or he's looking at the idea, they're looking at the idea of providing different leverage ratios for banks if they have holdings of green mortgage bonds and green electric vehicle bonds. Now, I have the incredible pleasure of being here with Luca Bertolo, who's the CEO or director of the European Covered Bond Council and European Mortgage Federation, who has been doing a huge amount of work, and their project, EE Map, looking at how we assess green buildings and the qualitative and quantitative benefits of green mortgages and green homes, I suppose, the valuation benefits, whether there are quantitative arguments for these leverage factors. That's been pioneering work. We're thrilled to be a junior part of that consortium, just helping by cheerleading on the side. Look, I want to ask you, it's a nice idea. What do you think it really does mean? What can the European Commission do? What do you think's on the table?
Thank you, Sean, for the kind invitation. Well, I think on the table is that the Commission is looking for a de-risking factor. So the core point is to identify the correlation between energy efficiency and the risk mitigation in the portfolio of a bank. Here we want to be instrumental, we want to be helpful, and we want to create a background for the Commission to do the proper analysis and then to allow a capital charge discount in case of energy efficiency product. As you mentioned, I think that our initiative is touching several of the recommendations of the high-level expert group. We want to create a consumer boost in the mortgage market, whereby consumers can invest more money in the renovation of their houses or buy new houses. This is done for residential properties, but also commercial properties. And all the data of these buildings have to be recorded by a new IT system, and all the banks should produce their mortgages in the same way. The idea is to launch a pilot phase. This will happen in Europe at the beginning of June, where more than 34 banks so far have shown interest in being part of this initiative, collect data, because simply data are not available so far. There is no information capturing the requirements of the European Commission. So we need to start from a white piece of paper and create a new IT system which will allow most of the banks to identify the correlation between risk mitigation and energy efficiency. This is what we are trying to do. There is a lot of support of the European Commission, of the banking sector. A lot of people are really working intensively to produce results as soon as possible. And we will be ready for providing a clear feedback to the European Commission and help them to give a green discount factor for energy efficiency mortgages. Thank you, Sean.
So the idea, just Luca, before I let you go, the idea is that this will be an incentive for banks to do more green loans to promote energy efficient buildings, one?
Well, I think it's a win-win process that is not starting from the banks, from the consumer. All of us will have an incentive when they will enter in the bank to get the green mortgages, because it will be cheaper, it will be more convenient, and it will be something like a revolving mortgages. Even new buildings, we know that they will not remain up-to-date to the market. So even new buildings have to be renovated over time. So there is a consumer story, then is a bank story, because the bank will have an interest in moving this up, but it's also an investor story. So the secret, it will be to create a win-win value chain from the consumer till the final investors, passing for a green bond, green covered bonds, green securitization, green debt unsecured. And the trick, it will be to develop a transparent way for disclosure rules. So the investors should have a clear understanding of where it's putting the money and where is the green factor. So that's the idea that we have created.
And the context for this, of course, is that 40% of the emissions cuts we have to achieve in Europe are going to come from the built environment. So driving energy efficient quality and low emissions buildings is a critical part of climate change transition plans, right?
Yeah, and I think the real challenge, it will be that in order to tackle this 40%, you have to convince everyone that doing works in their house is an interesting game. So it's very much a micro approach. We have to enter in the pocket of every single citizen in Europe if we want to change. There is no region, no European Commission, nor nation that is able to enter in the pocket of every single citizen. Only banks can do it.
Now, for those partners around this call, the table, who have big building portfolios, and I notice Bodo Winkler's on the line, for example. Hi, Bodo. Nice to have you on the call. How long is this going to take? This doesn't sound like it's going to be a 6-month project. This sounds like it's going to be a long time before the Commission is going to be able to bring in something specific.
Well, no, it's not something that will happen overnight. It's something that we want to be ready for the next mandate of the European Commission. So we want to finalize the pilot phase in this mandate. So trying to start to have a large group of banks operational in this sector on the pilot phase as soon as possible, which will mean not before January next year. We are launching the pilot phase in June, but before having any kind of operational impact, it will take a bit of time. But we want to be ready for 2020 when the new Commission will be in place. We will have a new Parliament and amendments can be done on the Capital Requirements Directive again.
Thank you very much, Luca. So you can see it's a major undertaking. There's a lot of work to be done, but there's a strong commitment to get it done. You're not going to see a green supporting factor appear overnight in the mortgage sector. Electric vehicles could well be different. The definitional universe is, well, it's rather easy to figure out what an electric vehicle is versus an internal combustion engine. The question there has been volumes of loans. But for those people providing leasing to electric vehicles, within 12 months, this could well be an opportunity, or rather, they could see some momentum in this particular sector. Moving on to the next recommendation. Here we're talking about establishing sustainable infrastructure Europe to accelerate the development of high-quality sustainable investment pipeline. I'm going to come back to that in a minute, especially when Ingrid Holmes is able to join me in the call. She's at the Eurostar stage at the moment, just dialing in. 7. Improve governance and better align corporate culture with long-term outlook. Now, there's quite a lot of discussion there. I'm not going to go to the details, apart from it's worth reading what is a very well-written report, thanks to the drafting committee, about the issues involved in tackling this. You know, we're very clear that many of the challenges that we face in society are, in our financial system, to make it sustainable, relate to an imbalance between short-termism and long-termism. Of course, we need both. Of course, there are many situations where you need to be able to get cash quickly, you need short-term liquidity and so on. But in many areas, there's a complaint, a justifiable, a documented, an evidenced complaint that short-termism leads to perverse outcomes in terms of companies' internal plans. There was a study a few years ago in the US which showed amongst CFOs that when they had faced a choice between doing an investment that was going to have a 3-year payback and an investment that would have a 6-month payback and lead to a better share price but have a worse effect than 3 years, they would always take the latter, which is not a great way of trying to manage companies sustainably or contribute to the sustainability of economies. There are clearly issues we have to tackle. It is complex, it is difficult, and achieving a balance is important. There is no suggestion that we need to go entirely long-term and forsake liquidity and all those sorts of issues. There will be an opportunity, I think, for many parties in Europe to contribute to a consultation phase around all of these things as the Commission launches into a process of making proposals to go to change. Finally, we have sustainability in the supervisory mandate of the European supervisory authorities and extending the horizon of risk monitoring. Well, the Commission actually announced in the middle of the year that they were going ahead with this. This was in our draft report, our interim report, I should say, published in July. Very soon after, the Commission said that this would be something they'd be introducing, and now the work has already been undergone for 6 months now on exactly how this is going to work. We haven't seen the final statements, but we know they're acting already. I'm now going to have a look at a couple of specific areas. The first area I'm looking at is a framework for sustainability, a taxonomy of sustainable investments. The starting point of this has been to look at mitigation-related investments. Some of you will be aware of the work of the climate bonds with its climate bonds taxonomy. Others will be aware of the work of the development banks through the MDB Working Committee on climate change definitions. And IDFC, the Club of National Development Banks, has also done work and has more recently been coordinating the MDB's group. The Chinese government has got a green bonds taxonomy, which looks at climate mitigation investments and other investments related to addressing environmental challenges in Europe. Even the regulators in India and in Malaysia and in Indonesia have now put out various versions of taxonomies, very thin. The Green Bonds Principles taxonomy is just 7 line items or 8 line items, so very shallow. It's very clear now that this will be a useful contribution to growing the market. In the green bonds market, we have grown this market very successfully with relatively little guidance and an investor due diligence approach. Make your claim, let the investors decide. While we've had investors that have an ability and capacity to be able to make that examination, the market has been served well. This market, though, grew 80% last year. It was $155 billion of issuance. We actually expect $250 billion of issuance this year. It's growing very fast. It's also moving into many nooks and crannies. We now have companies from around the world issuing green bonds in multiple markets. As we grow, it brings in more and more investors. Those investors have much less capacity to examine the claims, to do proper due diligence. The benefits of having a clear guidance from the European Union, from the Chinese government, and from the other governments that are tackling this issue, then become very palpable. It makes it clear that some things are in, that something's out. It reduces the risk for investors that they might do something that is seen as not green enough by the market, and they may get a public relations blowback or some lack of investor demand. It makes it easier for them. Equally, for investors, it gives them some guidance. They will always make their own decisions, of course, but it gives them some guidance about how they might operate in this market. And for the smaller investors, someone is doing a lot of the due diligence for them to take a load off their back, given they hardly have any internal capacity to do significant examination of these assets. In that framework, we think a taxonomy is going to be a very important contribution. Now, of course, this taxonomy in some areas will have to become very precise once we have incentives. So, as Lucas said, with the green mortgages section, we will expect very clear definitions of inclusion criteria for what is a green mortgage in the context of any green supporting factor. Ditto, clearly, with electric vehicles. In other areas, this taxonomy will stay relatively high level until such time is that we start seeing incentives which will drive the need for very specific criteria. The climate bonds certification will continue to do work into this for voluntary certifications where people see them as being useful. The key point about this taxonomy is we're going beyond climate. Not that we are going generally and loosely into various other sectors of the economy. We are trying to maintain an integrated, a coherent approach to these sectors. In particular, what we've done is looked at the UN Sustainable Development Goals. We've looked at the kind of assets and projects that would be relevant there, and we've looked at the overlap, the integration with climate issues. As you may know, as you may appreciate, we've been rather unsuccessful in addressing climate change and emissions in the last 25 years. We are now entering a world of volatile weather. It'll get more and more volatile as the century unfolds. We now need to tackle resilience in emerging markets where their carbon footprint might be very low, but where they are most exposed to volatile weather. Resilience is a really critical factor. It's a critical factor to ensure that infrastructure that's built there will be able to survive regular flooding or heat stress or various other impacts as a result of volatile climates. It's important that economies are resilient because they're going to be hit by much more severe weather incidents in the future, and if they can't bounce back from those, we will see collapse of economies, as we've already seen in places like Syria and Somalia. Some people argue these particular conflicts were induced initially by climate change crises. We will also see a need for social resilience, for ecosystem resilience. One thing we know about ecosystems is that when they become fragile, many ecosystems, like the fisheries of the world, are fragile because of overfishing or depletion of biodiversity, that they collapse more easily. The more robust those ecosystems are, the more diverse, the healthier they are, the better they're able to bounce back from cataclysm. These are all ways we need to be looking at development goals for emerging markets, at natural capital issues. And in fact, when you look through the UN Sustainable Development Goals, while one of them addresses climate change, all the others can be characterized as addressing different forms of resilience. Let's take inequality. We know again that societies or economies that are very unequal are also socially fragile. Take a big climate incident and they often descend into collapse like Somalia has. If they are relatively equal, they are more robust. This is now very clear evidence, as was part of a lot of study over the last 100 years in many countries around the world. So therefore, in terms of climate resilience, in terms of ensuring that people can build their lives again quickly and maintain a productive life within their countries, we need to be tackling issues of inequality. Otherwise, the states will collapse and they will be migrating. They'll be migrating, as they currently are in many places, within continents. And as many people like to say, they'll be migrating across the Mediterranean in tens and millions, not just in millions. That's what the future holds if we don't address these issues. So the work we've done here is to try and integrate the UN Sustainable Development Goals ambitions with the taxonomy around climate issues and provide a coherent approach for investors. This is a work in progress. This afternoon, the Commission is publishing the detailed work in process as an appendix. It'll be on the website for the European Commission, which is effectively taking this chart you see in front of you and giving you the many pages of detailed spreadsheet to see what the implications are in different areas. I want to stress, though, this is not meant to be something ready to go. We need to have widespread consultation and input from climate scientists, first of all, from development experts, as well as from financial sector actors who can comment on the practicability of these definitions. Is this usable, or is this ivory tower pie in the sky? That's what we need to go through, and that's the recommendation we've made to the European Commission. They set up a committee to steer this process, that they bring in further experts to flesh out these issues, and they seek input from many different parts of European society, so that later on this year, a more formal taxonomy can then be published, which will, again, however, will be subject to annual revision. It's a dynamic, it has to be a dynamic tool. It can never be perfect, but we can get it good enough so it's useful for the financial sector in Europe. The next point I'm going to move on to. And I'm now just looking to see if we have any questions coming through. Please do send them on. The next question I'm going to now is, if I can make the system work, EU Green Bond Standard. I talked a little bit about that now. The main thing you need to know is that the Commission is committed to bringing in a EU Green Bond Standard. It will largely mirror the Green Bond principles. You will also see these very same principles in the Climate Bonds Certification and Standard Scheme, if you're familiar with that. The one difference is some things that are entirely voluntary in the Green Bond principles will move to become mandatory, notably the requirement for an independent review. And there is a proposal that there be a scheme of license verifiers modelled on the Climate Bond scheme of license verifiers adopted within Europe. Exactly how is an open question. But we will see movement on this during the year. What I'm a bit unclear about is the exact mechanics within the Commission to come up with a standard, because frankly it's way beyond our capacities to understand how it should be done. The Commission is now working on this, and on the 22nd of March we expect a very specific proposal to come from them. Next, I want to move on to the issue of Sustainable Infrastructure Europe. One of the most important recommendations from my perspective is how we grow the pipeline of green infrastructure investments in Europe. Of course, all of these will be bondable. All of these will become grist to the green bond market. But we need to get the actual projects underway. Here I'd like to invite Ingrid Holmes from E3G, one of my fellow members of the high-level expert group, and a long-time writer and analyst and researcher in this particular area, to join me on the call. Ingrid, are you there?
Here, Sean. Thanks. Good afternoon, good morning, everybody, depending on where you are. I'm calling from the Eurostar Lounge in Brussels, so apologies if it's a little bit noisy. I would just very quickly run through some of our recommendations around sustainable infrastructure. I think it's fair to say right from the start of the HLEG discussions, there was a twofold focus within the group on how do we rewrite the rules to make the financial system itself more sustainable, but also how do we refocus finance to deliver sustainable economy outcomes. And this is where the sustainable infrastructure piece was absolutely key. So we, in the text, set out 3 key functions for this new institution that needs to be thought of as an evolution of some of the institutional capacities that have been developed in the Commission and particularly in the European Investment Bank to date. We felt that there were 3 key gaps that more effort and attention was needed to address. The first is capacity to actually work upstream with governments to design investment-grade green infrastructure project pipelines. So what we hear time and again is there just simply aren't enough projects coming through. But actually a lot of this is about how the market rules are written, how infrastructure is funded. So it's very much in the gift of governments to design those frameworks. This builds upon some new capacity that actually has been launched inside the European Commission, the Structural Reform Support Service. This is an on-demand function to work with economic policymakers in governments in Europe to help them deliver key reform agendas, of which one is the Energy Union, which of course encapsulates the EU 2030 climate and energy goals. There is a process ongoing in Europe to turn those goals into something less abstract, more financeable. They're called national energy and climate plans, but those are still not really a roadmap for delivering finance. So what we're asking is that this new facility, born out of capacity that already exists in the Commission, it'd be a core part of the offer of Sustainable Infrastructure Europe and really starts to turn those national energy and climate plans into national capital raising plans, so working with investors to connect capital to the projects needed to deliver our public policy goals. We then talk about 2 other functions. First, to look particularly at project development capacity. So we know this can be developed in a top-down way by governments, but actually more and more importantly is corporates coming forward, and particularly cities and sub-national level regions coming forward with their own sustainable infrastructure projects. Just before Christmas, the European Investment Bank announced it was creating a new urban investment support hub. That's great, but it's still only a handful of people inside the European Investment Bank, and really what we'd like to see is capacity across Europe working very actively in the market to bring forward these sub-national projects. And then the third piece is really around new risk instruments to address policy and regulatory uncertainty in the market. So really it's a kind of a MEGA, so based on the can't remember the second word, guarantee facility that's been developed by the World Bank, but focused on Europe and focused on low carbon infrastructure. So those are the core proposals. The response we've had back from the Commission is we're interested. I think that there will be some institutional challenges with actually getting the different bits of the European Commission and European institutions together to make this a reality. There's a bit of a turf war going on, but what we've actually heard from some of the, apologies for the background noise, what we've heard from some of the DGs closest to the market is this is absolutely what is needed. So we applaud what the EIB has already done in becoming more activist in the market, but we really need to see a significant step change. And that's all from me, Sean.
Thank you very much, Ingrid. Are you still there?
I can stay for a few more minutes if there are any questions.
Just one question. This idea of a national capital raising plan, as you and I discussed, is not that simple. It requires a bit of work. Do we have precedents? How much time do you think it's going to take? How much work it's going to take? How much resource is going to be involved in getting this happening in Europe under this, in terms of the Commission's work and the work of other people? Give me a flavour.
So I think probably one of the more advanced discussions we're having on this is actually in the context of the UK. So the UK has very clearly set out its aspirations for infrastructure through its National Infrastructure Commission. It's also brought together the Green Finance Task Force, which is a sort of level of granularity below the HLEG, really looking at what needs to be done on the government and market side to deliver the green infrastructure needed to meet our carbon budget and clean energy goals. What we've realised quite quickly in that process is that just getting together and having a conversation about incentives is really not going to be enough, that this needs to be a focus on an ongoing dialogue between the public sector and the private sector on exactly which infrastructure, where and when, and what public money might be needed or regulatory changes needed to deploy capital in a way that satisfies the risk-reward profiles of the private sector. So how this is coming out in a very sort of detailed way in that conversation is that maybe we need to set up a working group within the forward national infrastructure planning of the National Infrastructure Commission. That could be that could then deliver a product which is a highly tangible, really investment program to deliver green infrastructure in the UK. So it's really a combination of knowing clearly what infrastructure where needs to be delivered and when, and then this dialogue between government and the private sector to actually work out the mixture of public and private capital and regulation to deliver it. We're seeing other bits of this as well, of course, in China through the 5-year plan. In Mexico, Banabra is running this kind of policy dialogue. So there are bits of it emerging, but I think it is still, unfortunately, quite a new discussion and something we do need to move further forward on.
Thank you, Ingrid. That's been a great explanation of what the HLEG report is looking at and what the issues are. I understand, gossip has it, that now that you've done the big public policy piece, you're moving to Hermes to look at implementation and actual investment in this area. Is that right? Are you at liberty to tell us?
I am, so it's not public knowledge now, but I guess we'll be pretty soon. I'll be leaving E3G to go and join the Hermes Investment Management within their responsibility team, really trying to build a dialogue around how we move from the HLEG into implementation in the EU, the UK and other jurisdictions. So very much looking forward to taking the conversation forward in that new role.
Great. Thank you for joining us today, Ingrid. And there you go. She's off to actually make it happen now, having worked on the proposals. I'm now going to move on to the next section. We have also a list here of what I'd call cross-cutting recommendations. Let me just run through a couple of them. Feel free to ask questions. We talked about the need to promote financial literacy and improve access for citizens to information about sustainable finance, where there's a surprising paucity about it. We think the Commission can take some steps around that area. To back up some of the work that Ingrid's been talking around on sustainable finance, we think there is a need to extend this idea of a EU observatory to track and monitor progress. You know, it's a bit like the weather on the news. We kind of need a note that comes up that tells us how we're going on our targets, that all of us can understand, all of us can think about the implications for us, or at least all of us in the financial sector. So some kind of proper monitoring by Eurostat or whatever could be done, but we think a specialist observatory on sustainable finance would be particularly useful in this circumstance. We think that there's a need to improve transparency and guidance on benchmarks indices. They are so influential. You know, clearly the first answer is, well, we only do indices for the market and what the market wants, but they have a self-fulfilling prophecy now, where the indices are so dominant and so used by many parties that the market follows them. We at least need to ensure that there is full transparency around the thinking behind the indices. There's a question mark about that. And guidance on benchmarks, as I said, and there's a World Benchmarking Alliance meeting in Kuala Lumpur on Monday, and that's one of the areas it'll be examining. I know Steve Waygood from the high-level expert group will be in Kuala Lumpur talking about this issue. How we bring sustainability objectives for Europe into everything is what we're looking for here. There is a need to look at alternative accounting practice, particularly with mark-to-market valuation in long-term investment portfolios. This is a complex discussion for those of you who aren't familiar with it, but a very important discussion about the extent to which mark-to-market valuations has, to a certain degree, inadvertently, coloured thinking in organisations, in investors, in corporations, in a way that leads to shorter-term focus rather than longer-term focus. A different approach is required here. We know that we need to be looking at the impacts of energy savings on underlying asset value, as Luca has said a little bit earlier. We think there's a sort of general think sustainability first principle that needs to be looked at when it comes to legislation and regulation. For example, when Basel III and Solvency II were being discussed, there was not a hint of a conversation about any other issues apart from addressing the issues. And yet, as the insurance industry has been very vocal in saying, the initial Solvency II recommendations inadvertently would bias their investments against the very long-term investments in, say, renewable energy that Europe, in other parts of its policy body, was crying out for. Unless we at least have a proper discussion about the linkage between different sorts of policy priority issues in the sustainable, especially climate change, which is such a near and present danger for our economies, our societies, our children, we're missing a trick. And in fact, one of the key recommendations or discussions in this particular report has been for the need to regulators to start doing scenario planning for the future rather than rely on history, on backcasting, when they're considering the impact of new regulations or new regulations that might be required. This is picking up a theme from, of course, the Task Force on Climate Finance Disclosure, where there's an argument that all institutions need to be doing now scenario planning because we're entering into a world of volatility, a world of potentially major impacts of climate change, and, of course, impacts on financial sector of policy moves that are beginning to happen in some markets as well. There are many issues here. So think sustainability first. And then finally, we've made a recommendation about taking this discussion, about taking the report, the work that European investors and banks and consultants have already done, and organizations like LSE with its FTSE for Good, or the different exchanges, Luxembourg with its Green Exchange, taking this soup of sustainable initiatives and sharing that knowledge of other countries and developing bilateral discussions with key countries that are interested in doing this. This, unfortunately, is not a time to push this through the G20. We have one country that's saying no to everything, pretty well everything. We therefore think that in the short term, there are opportunities to work bilaterally with China, bilaterally with India, bilaterally with Brazil, or to bring those countries into a coalition of the willing that want to actually advance on the issue of sustainable finance. We think this is a critical area where the European Union should, on the basis of its history, on the basis of its mission, on the basis of its whole intent, and on the basis of its experience and practice, take a leadership role in promoting sustainable finance reforms internationally. We know there's appetite in those countries to have a dialogue about those issues. There are many reasons why, including the need to shift capital to sustainable investments in emerging markets. And from a climate change perspective, 70 to 80% of all investments involved in addressing climate change in the next 50 years will be in emerging markets, fast-growing markets, urbanizing markets, population-growing markets. Of course, if we do this right, we can ensure that we get adequate yield with minimal, reasonably low risk, so as to pay the pensions and the insurance policies that we're having such difficulty now paying because interest rates are so low, because our growth rates are so low in rich countries. This is one of the discussions we have to have. But as well, there are also issues. India is wrestling with how it reforms its financial system to be more supportive of the needs of the poor, to be more supportive of the transition that it knows it's going through the next 3 years, as well as being supportive of the environmental agenda. People in Delhi have the worst air pollution of any major city in the world. They understand the environmental agenda. They're looking for ideas. They're looking for collaborations around this. This is a big opportunity for us in Europe to show the world what we've done and to bring others into this particular stream of thinking. We won't need to exclude the US entirely. We may need to exclude the current government in Washington, D.C. But later this month in Santa Monica, the Treasurer of California will be having a Green Bond Summit. In September, Jerry Brown, the Governor of California, will be having a Climate Finance Summit, bringing people from around the world. In New York, Maria Cuomo has been forthright about the need to transform New York's economy. We have many subnational actors that want to be part of this activity as well. A global discussion about how we take this issue forward is something important to see in coming years. Okay, a few key sector recommendations. I've already mentioned many areas, but let me just recap. The Commission will support the development of ESG and longer-term sustainability risk assessments by regulators and others, and to investigate the risk differential for green supporting factor, that is, Luca Bertolot's green mortgages or electric vehicles. Insurance companies need to look at disclosure. The European Commission will support that. We will be looking to review Solvency II to support long-term investment while maintaining a risk-based nature. That is a practical example of thinking sustainability first when it comes to regulation. The European Commission will need to promote higher standards of competence on ESG issues, environmental, social and governance issues. We expect pension funds to be doing things like consulting beneficiaries on their sustainability preferences as opportunities arrive, and improving ESG integration and reporting beyond what is currently required. Exactly how that manifests itself in European regulation, we have yet to see, but you get the intent. We know that credit ratings and sustainability ratings are going to be important or need to be looked at in the context of ESG. The European Union should support much work in this area. Stock exchanges need to be promoting disclosure of ESG information. Many are, by the way. We're pushing on an open door here. This is not a closed door. We're simply encouraging and promoting these changes. Of course, there's opportunity to review the incentives of financial instruments too, like green mortgages. Investments consultants need to be looking at their own ESG and ethical competencies in the context of the kinds of challenges we're talking about, including the challenge of climate change. We have some particular issues in relation to asset allocation, in relation to appreciation of where economies are going, more discussion, more examination, and more action will be required from these sectors. And then finally, we're looking from investment banks, more long-term research from sell-side analysts, and we expect the regulators to be encouraging that in future or promoting that. In terms of bonds, some of you have seen our broad recommendations for 2018, more sovereign bonds. We have many countries in Europe looking at sovereign bonds at this stage, and we expect them to come to market this year. As a result of the Sustainable Finance Taxonomy and the Green Bond Standards work, we expect to see a renewed emphasis on harmonisation across different markets, between China and Europe first, between the ASEAN capital markets, green bond regulations in Europe, and so on. We do expect to see regulators innovating. We've already had in China fast-track approvals for bonds, liquidity window access, and so on. Now we have capital requirement initiatives on the agenda in Europe. We think there's going to be a lot of pressure on the banking sector to lift its green lendings through all of these measures, and frankly, a lot of reputational and political pressure too, so that the banking sector can be seen actively to contribute to the change that's required to avert catastrophic climate change. We're seeing it. We're seeing announcements all the time. Bank of America told me recently they have nearly exited their last coal loan. We have many banks around the world, in fact, that are saying they will lend no more to coal because of its environmental implications. We've seen a reduction in fossil fuel lending in general by some institutions around the world. We've seen strong, powerful commitments by banks, by investors to grow their allocations to green investments, whether they be green bonds or renewable energy or other kinds of activities. That change is underway, but of course it's not yet fast enough to address climate because things are happening so fast. We will see, we believe, investor demands on the largest emitters to demonstrate transition. In fact, I believe one of the big index companies is going to be preparing a transition trajectory index, looking at companies that are moving from brown to green at speed. So the speed of change with the primary indicator there. And we already know some investors are quite keen on that idea. And then, of course, I've mentioned before the link between green bonds and SDGs and green finance. We will see what have been so far separate tracks in global thinking merge into one. We believe we'll see about $250 billion. We hope for $300 billion of issuance this year. Our goal is to keep doubling the market every year to make a big impact. A sustainable taxonomy will guide harmonisation, drive growth, make it easier for everyone. Investor duties, we think, will be part of increasing demand for green bonds. Disclosure rules will put pressure on people to shift from brown to green. Retail green bonds, we think, are a totally unexploited, underexploited area. Retail savings products, retail products at all in this particular area. We've seen a few dabbles in South Africa, Nedbank has had term deposits, which they're calling green bonds. With the marketing campaign for that product, 30% of the people who signed up were new to the bank. It was a fantastic customer acquisition strategy. No one else has done this in the retail sector yet, apart from Triodos in a small way in the Netherlands. There is much scope, we think. An example of the scope, Ant Financial, the largest fintech company in the world at the moment, in China, which uses Alipay to allow citizens of China to pay by the mobile phone. It's the dominant payment system now. Earlier last year, in March, rolled out a little tweak to their interface, which allowed people to sign up for a carbon counter. You had to know what it is to sign up. You've got to fill in a form. But when you sign up, it calculates the carbon footprint of all your purchases. An interesting indicator of whether people are interested in these ideas, as long as you make it easy for them. When your carbon gets to a certain level, they plant a tree. Well, to their shock, they've had to plant a lot of trees. Within 3 months, 200 million people signed up. That's 200 million people. That is an indicator of retail interest in green initiatives. Make a financial savings product easy for people, and we think it'll go like hotcakes, which is why we need initiatives like labels to ensure there can be trust in these schemes going forward. So we think a lot of these things are going to be part of the future. Sustainability standards we talked about. Most importantly of all, the most important part for me of this proposal, this report I should say, the HLEG report, has been the discussion about how we grow infrastructure in Europe. That's where the transition occurs. Most of what we have to do to address climate change is about building the right kind of infrastructure. Clean energy, grids to connect clean energy, low carbon transport like rail, green buildings, water supply that is sustainable, and so on. Green bonds can help bring these issues to the fore, can ensure greater alignment of corporate culture. In fact, for those of you that don't know NN investments in the Netherlands, I commend to you a report they've just done, which has looked at the halo effect of green bonds. There is some discussion. You will have to make your own, arrive at your own judgment of whether you agree with this, that issuing green bonds by some companies has an effect of depressing rates for all bonds. There is a halo effect that comes through. HSBC had done a bit of research about this 2 years ago and asserted the same thing too. I'm making no comment, we haven't done the research, but it's a very interesting line of discussion, line of examination going forward as a way not only of, green bonds are not only a way of companies getting benefit from the green bond, but of also signaling to their equity investors what they're doing and to their other bondholders across the company. Let's see how that goes the next couple of years. We know European supervisory authorities are going to be moving on the issue of addressing sustainability factors with their risk horizons. What to expect next? Well, a directive on non-financial disclosure this year. There will be disclosure requirements around the performance of underlying assets. The priorities from the Commission have been, they've said to us, integrate sustainability factors into investment mandates, the taxonomy, green standards, and green lending. We've had a landmark report, a report that has been very interestingly, actually widely supported. Of course, there are things to argue with by different parties. We certainly expect in the next few months much discussion about it. But I'm going to tell you, in the talks I've given around Europe over the last 9 months, especially the last 6 months, and the talks of other high-level expert group members from Poland, from Finland, from France, from the UK, the response has been very supportive and very strong of the broad thrust of the recommendations. It's a question of not should we be doing this, but how do we do this best? That's, I think, an important point to note about this particular moment in European history. There is an appetite for change. There is an appetite for addressing this in all actors, especially across the financial sector. The question is now, what are the most effective and most efficient ways of taking this forward? If you have any questions, you need to ask them now. We are wrapping up in a couple of minutes. I do want to say to everyone, thank you very much for hearing us out. Of course, if you want to ask questions by email, most of you will know my email address, sean@climatebonds.net, and of course you have Katie's email as well. Please do contact us. Please do start a discussion. please do ask questions about the HLEG report, and we'll attempt to answer it. Mostly, I would like, if you're interested in this area, to commend that you read the report, which is, for a report on what can sometimes be seen as a very dry topic, a racy read. The drafting committee has done a superb job of making it easy, simple, so that even our time-short, attention-challenged politicians will be able to grapple with some of the issues here. Thank you for joining us today. I look forward to talking to you over the coming months about the implications of the Commission's actions and about how we can work together to grow the green bond market and to make sure that we do address our global challenges around climate change. On that note, in the absence of immediate questions, unless Katie comes in and tells me that there's something I need to do, we will sign off. Thank you, everyone. Have a good weekend.